think we're all here together. Although, yes, I think this is everyone. Perfect. Thank you so much for joining our panel. We're here to talk to you and also for listening to my presentation. We're here to talk to you today about creating a sustainable and effective investment strategy. I'll give it to my panelists to briefly introduce themselves. Thanks. And Melissa, since you're on my screen, why don't you go first?
No. Okay. Hello, everybody. Thanks for joining us. My name is Melissa Brown. I'm the head of applied research at Contigo. Basically, for the past 12 years or so at Contigo, I've been writing about market issues, portfolio construction issues, and ESG and sustainability issues. So I look forward to talking with all of you.
Great, so why don't I go next? Hello, my name is Ronja Westheinrich. I'm joining you from ISS ESG, one of the leading ESG research and data providers operating globally. And here at ISS ESG, I am the methodology lead for our regulatory solutions and fixed income solutions. So dealing a lot with all of the regulations that were just presented in the previous presentation by Dylan.
Jean, would you like to introduce yourselves next?
Yeah, hi, thank you for joining us today. My name is Jean Jardel. I'm quantitative researcher at Canopy AM. We are a Paris-based sustainable equity asset manager. And I am personally responsible for the allocation throughout the algorithms and all the data management of the company.
I think some of our panelists may be having sound issues. I'm not sure, Elaine, Iancu, if either of you are able to introduce yourselves.
I can hear everyone. I can't see anyone. That's a different issue. Can you hear me?
We can definitely hear you, actually. So that's
right.
Perfect.
So hello, everyone. My name is Iancu Daramus. I'm a director for climate-aligned investing for Fulcrum Asset Management. We are an independently owned asset manager based in London with offices around the world, including in Australia. And I work on both the construction of investment strategies, as well as engaging with investee companies on climate change, and more broadly, heavily involved with peers on defining methodologies on sustainable investing, working groups, trying to crack some of the harder questions in this area.
And last but not least, Elaine, would you like to introduce yourself as well?
Yes, hello everybody. So I am Alain. I am Chief Risk Officer for Sycomore Asset Management. Sycomore is a specialized investment management company on sustainable investment. We are part of Generali Group, and we are managing between 7 and 8 billion euros mainly in equities and corporate bonds in Europe.
Amazing. Well, clearly we have a extremely hands-on ESG investment panel today, so it's going to be very interesting. Before kicking off, just wanted to highlight we're open to audience Q&A, so if you have questions throughout the panel, please feel free to let us know. So to kick things off, amid a volatile and complex global economic environment, sustainable investing appears to be moving full speed ahead, particularly in Europe. With all the interest today in sustainable investment and sustainability risk management, we'd like to use this time to talk with our panelists not just about sort of investment strategy, but also about how you actually implement those sustainable investment strategies and the challenges and opportunities that practitioners are seeing today in the market around doing so. And of course, data providers and technologists as well. To kick things off, I wanted to ask the panel, what is the biggest challenge you're seeing today with implementing a sustainable investment strategy? And Alain, this would go to you first.
Okay, thanks a lot. There are many challenges in implementing a sustainable investment strategy. But the biggest challenges that we are facing, first of all, is how we have a definition of what is a sustainable investment. There is clearly a lack of standardized criteria for what make an investment sustainable. We can see it from the maybe from the panelists that can talk, because we have so many companies that are doing some ESG scores, and there is not a lot of correlation between the scores that are published between the companies. So this is the first one, the standardized criteria. The second one is the framework. It's clearly a complex framework, increasing legislation or regulation. We can see that in Europe, we do not have the same definition than in the US or in the UK. So when we are building a sustainable investment fund, we have to choose in which region we are going to sell it. So it's very difficult to cope with all these different legislation and regulation. It's very difficult to build something that can be addressed as a sustainable investment fund for all the region. And even in one region, there are differences between the countries. There are different level of knowledge between the countries, but also there are not a standardized metrics once again on what makes a sustainable investment. So this is very difficult because you can have your own definition and the investor has another definition. Third challenge is the lack of knowledge, because today there are many new metrics that we have. We have some metrics on E, on S and G, and we are also going to new type of metrics. So this is very difficult to educate investors, but also the board of directors to make them understand what is a risk, what is a risk in terms of ESG. There are completely different risks on ESG than what we are used to measure. As of today, we are measuring some financial risk, but ESG is some other metrics. For our environment, it's mainly some physical measure, which are completely not physical. So we have to combine our physical metrics with some financial metrics, which is very difficult. So we have a lot of education to make for investors, for board, for everybody, in order to have something that is more and more consistent.
Did someone want to? That's a fantastic and well thought out response, and definitely the sustainability definitions are non-standard, and it almost feels like we're in a Tower of Babel situation at times with the definitions.
Dylan?
Yes, go ahead.
I would just add one more challenge to that, coming from the US perspective, and that is the fight against some of these measures by local governments, which I think makes implementation even more challenging.
Mm-hmm. Maybe I can also add from a data provider perspective. Of course, Alan was already mentioning that we may not always come to the same conclusions on the same issuers, but I think, as you already mentioned, Alan, there is just different questions, and I think it's really important that users of the ratings understand and think for themselves, what is the question I'm asking? And different ratings might be answering different questions and therefore also coming to different conclusions. And one key consideration in that really is your understanding of materiality. So you already mentioned that as well. Am I coming from a financial materiality perspective, or am I coming more from an impact perspective, or am I looking at a double materiality like the EU regulations are embedding?
I think this is a great spot to sort of transition to our next question, given especially that, yes, materiality is something that one needs data to understand. So data is one topic that keeps coming up in conversations around implementing effective sustainable investment strategies. Could perhaps the panel talk a bit about sort of aspects of ESG data, scoring, and regulatory alignment data sets that purchasers of ESG data and users of it need to think about in terms of selecting and preparing the right data sets to fit into their investment strategy? And I wanted to give this to Iancu, if you could talk a bit about this now.
Sure, and thank you. I'd like to come to this, but in a slightly roundabout way, because it's very, very common to point out problems with the data, or to say we don't have various bits of data, right? I hear that a lot. And sometimes I'm a bit skeptical when people say, oh, if only we had the data, then we'll finally be in a position to start all this sustainable investing conversation, right? And my challenge to that idea is, data cannot help you answer some of the fundamental questions which have to do with investment beliefs. Should a sustainable investment fund be on average green, or have all its holdings green in some sort of sense? Data can help with these issues, but it cannot answer them for you. So as far as we've seen it, I think we do need to bring in mind this idea that once you've defined your investment beliefs. Is climate change a significant risk? Our pedigree is in macro investing. We're on the lookout for macro shocks, macro trends. We've decided, for example, that we would like most of the long-term holdings, the long-term equities we invest in, only long-term, those would like all of them to be climate aligned. Now, that starts with an investment belief of how to position a portfolio, and then you talk about the data. And I think this is an important point that, investment beliefs come first, and I think then data, once you know what question you're asking, then you know what data points to start looking for. And once that, of course, then you do start to interrogate. And as it's pointed out, there are a lot of questions, there's inconsistencies, all of that are important. For us in the climate context, I would say one of the important sort of mental shifts that's happening is this idea from backwards looking to forward looking data. So if you think about investing and not just, avoiding, take out a few stocks from an index, they're done. I've halved my carbon footprint, I'm an aligned investor. I don't think that's the way to do it. So to think really about which data points can give you an indication of where companies are going. Where a company is today in terms of its carbon footprint may not be where it's going tomorrow. So really looking under the hood at all these elements around future targets, the strengths and credibilities of targets, are management rewarded for meeting the emissions targets that they've set out? All of these issues, I think, are things we're on the lookout for. As I've said, we're involved with industry groups where we don't exactly, and maybe the entire industry doesn't really know what the answers are. We invest, for example, in long and short strategies sometimes. What's the carbon footprint of things that are on the short side? All these things are not fully sorted out yet. We're also building our own databases to sort of reduce our reliance on some of the third-party methodologies, which aren't always clear. But again, the point on data for me is you cannot outsource the responsibility of the role that data will play in your investment strategy. So, if you're a company, you don't have any emissions targets, for example, that's a data point, yes, but what do you do with it? We will vote against any director or against any company that has no emissions targets. That's what we're doing with the data. So I'm trying to wrap up, just to try and bring these two things to keep them into perspective. It's very often to go on conferences and people always complain about data, very legitimate points raised there. At the same time, the investment beliefs and the use of data and how much do you allow them to drive your investment decisions, I think are also the other side and just as important, if not more important side of the conversation. So thank you.
Yeah, and to complete the answer, we can see that on the quantitative angle. Once we define the question precisely, which is detrimental to have a clear sustainable strategy, then we can look at the data. And what the data tells us is, depending on the provider, you have data that are really, really different for a single company. And once you have all your different sets of data, then you can start implementing your strategy. But depending on the provider you select, at the end, you will have a completely different portfolio. And this is really something that was enlightened in 2020 with an article of Florian Berg, which is the director of the research at Canopy AM. And we're really enlightened that some companies were really good position for being environmentally sustainable, and on the point of view of one provider. But on the other side, another provider says, okay, this one, it's completely the opposite. This company cannot be considered sustainable. So once we have the question to answer it, it's really depending on the provider you're selecting at the end.
And yeah, I guess beyond sort of just using the metrics to kind of stratify which investments are sustainable, there's also the issue that data and ratings can be different between providers. We spoke a little bit about this in our last panel, and there's a lot of complexity around it. And so another aspect of ESG that actually keeps coming up is subjectivity. Sustainability means different things to different people and in different contexts, including between data sources and ratings providers and across the investment landscape. Could sort of you please share your views on subjectivity in the context of the sustainable investment and how you're able to navigate it? And I wanted Jean to take this back to you to kick this off as well.
Yeah, sure. So the question of subjectivity is really to be posed after we educate people. Alain said just before, education is key. I'm personally quite young. I started working in asset management a few years ago, and actually in my whole educational pathway, there was no single course of sustainability investment and things like this. And this is really something that's missing. And we are focusing on this to educate people from the younger age also, because those people will be the next ones to approach those questions. Now, if we come back to subjectivity, if people are educated, sustainability is still a wide concept because it really concerns different aspects of any business, from operations, human resources, governance. Sustainability can concern any different aspect of it. And it can also concern the business itself. So it really depends on the angle the final client is looking at. And for example, you have companies developing enabling transitional activities. Nothing ensures us that those transitional activities that are environmentally sustainable are developed in a way that is socially sustainable. And that can be really the angle that the final client is looking at. That's really important, because one client can see sustainability in a company that invests in transitional activity, whereas another client is going to see, no, this company is not sustainable because it's not socially sustainable. And this implies disagreements between all the market participants, actually. So it's really difficult for regulators to formalize a precise definition of sustainability, because everybody is not agreeing on a single definition. However, there is a consensus between asset managers and investors in general that some companies cannot qualify as sustainable. We have indicators such as the NSH and the minimum safeguards that were defined in the SFDR regulation in Europe. And all those different criteria, we are quite agree that some companies cannot belong to the sustainable class. To navigate this subjectivity in the sustainability, there are some tools, some metrics that we can use, like the number of Article 9 funds in Europe, for example, that invest in companies and in a single company. So we can see if this company is really present in a lot of different Article 9 funds. This is one indicator, for example. But the key thing is to precise the definition of sustainability and bring a sort of coordination between market participants to be able to combine forces and make, I want to say, sustainability great again after the wave of Article 9 withdrawals that we have seen in 2022.
Yeah, thank you so much for that. Oh, go ahead, please.
Yeah, I agree with Jean. In fact, there is subjectivity is part because we have no clear definition as of today. So it's something that is obliged because we don't have a standard definition as of what is a sustainable investment is. And we are just, I won't say we are at the beginning of the journey on a sustainable investment, because it's now we've been in a sustainable investment for a long time, for quite a few years. But what is happening today is that the definitions that we have today as a sustainable investment may change in the next couple of years, or three years, or 5 years. We don't know. But even in the short term, what I mean is, even in the short term, things can change. We've seen that with some different metrics that have been imposed by regulators or labeled, etc. They are changing. As Melissa said, there are also some pressure sometimes from political pressure, and things are changing. Things are changing because if you look at the Net Zero Insurance Alliance, 3 months ago there were 30 companies. Today there are only 11 or 12 companies, I don't remember exactly. But things are changing, and they are continually changing because we have no clear definition. And this is something that we need to cope with. We need to be prepared to change our definition of what is sustainable, because we will have new data, we will have new definition, and we will have better definition in the future.
Could I briefly make a small defense of subjectivity? What I mean by that is not so much, everyone, it's all a free-for-all here, but there's another way to look at this, which is to say by subjectivity, you mean you make judgments, right? And those can be reasoned judgments. I'll give you one quick example. Everyone's very worried, reasonably so, about this idea of scope 3 emissions, right? Not the emissions that come from your factory, say, or the power you buy, but something else in your value chain. It can be upward, your suppliers, or downward, your consumers, right? Now, with scope 1 and 2, with what's within the factory gate, so to speak, if two companies have the same emissions, they have roughly the same carbon risk, right? For every ton, they pay some carbon tax. Simple. If two companies have the same scope 3 emissions, we've no idea whether they have the same carbon risk, because they may be able to pass on their cost to the consumers. If carbon prices rise, then demand may or may not be elastic. It might affect their sales. So it's for investors and others to start to think about what the implications are. And I don't think this is something that can be just standardized, because that's precisely the point. These things vary, and they will always vary, and the materiality will always vary. This is not something that I believe the regulators can come in one day and will tell you exactly where they are material. They can broadly point to things, the oil and gas industry, clearly they're material. But my point being, it's not as if standardization or better data can help outsource this problem. It's still up to us to think about what the implications are. And I think there will be many areas like that where it is up for investors to make judgments. I don't mean that in a completely subjective and random and arbitrary way. It's reasoned, but judgments, I believe, will remain a fundamental part of the sustainability conversation.
And I think that's a really interesting point to sort of talk about our next topic, because you mentioned that sort of, at the strategic level, investors will always have to make decisions in terms of how they use the information that is being disclosed upon, even if that information is standardized. One of the aspects we wanted to talk about as well in this panel is sort of passive and active strategies, which is a question that kind of coincides with this topic of sort of how do you design indices, or if you're an active manager, how do you implement your sustainable investment processes. I was hoping, Melissa, if you could kick this off and by sharing your thoughts on this dilemma of sort of whether to go passive or active in ESG and how it plays out in your domain.
Yeah, well, I think that's a really good question, and it does tie in quite well to this discussion of materiality. Certainly, there are many passive options. Part of it, though, is how do you want to define passive? If you're defining passive as being as close as possible to some market cap weighted benchmark, then there are certainly alternatives where you're not straying too much from some market cap benchmark, but somebody else is defining what's material and what the nature of that investment is going to be. There's also passive options that are much more narrow, let's say a biodiversity index, it's still passive in that it's very rules-based. You as the end user investor don't really have any decision-making capability, but you're getting a much narrower view of that investment, of that sustainability metric. So I would say both of those fall into the passive category. In both cases, you as the end user, as the investor, don't have much say in what's happening. But I would say maybe one of the biggest downsides of that passive view is that you have no way to engage with the companies. And so somebody is making decisions, you may agree or not agree, but you can't, drive the companies that are invested in to do something or not do something. So I think that's one aspect of it, and also then somebody, as I said, has defined what's material there. So on the active side, you certainly you have a better chance of picking and choosing what is your goal for your sustainability. But the downside maybe of that active investment is it's going to be more expensive. That's maybe the biggest downside, and it's harder to manage. So I'm not coming down on one side or the other. I think it really is up to the end user investor, how much they want to pay, how much they want to differ from the market overall, what they consider is material. How much they want to have the ability to engage. And so, I think that it has to be answered by the individual asset owner. Because there certainly are positives and negatives for both ways of investing in a sustainability type strategy.
Well, Melissa, you certainly left us with a lot of really interesting thoughts to follow up on. I definitely agree that some of the considerations, how much investors want to pay, how much they want to actually be contrarian versus kind of align with the market, and how much they want to engage are definitely key considerations when evaluating managers and funds. I remember earlier in this presentation, one of our panelists, I think it was Jean, mentioned that you could look at Article 9 funds and what they're holding to understand the market and to sort of get that perspective. So maybe that's helpful as well to investors. Did anyone else have wanted to share some thoughts around passive or active and what they're seeing in their funds? I know we have, I believe, some active managers with us. So yeah, I would love to get your thoughts.
Yeah. Actually, what I can see is when we talk about sustainability, I would like to say everything is good to go with. Passive strategy is a huge, I want to say, tool to reallocate funds to sustainable strategies. But at the end, in passive strategy, we know the downturn is we don't have a massive engagement inside the investing company. This is the downturn. But on the other end, we have the active strategy for which the engagement is much higher because we can directly interact with the investing company. So we have both the massive capital flows from the passive strategies and the engagement from the active strategies that combined, I think, can have a huge impact on the overall sustainability finance, sustainable finance. Yeah.
If I could briefly come in on that, I think it's important to bring two slightly philosophical points. One is, whichever fund you're investing in, I think there's a problem about how willing you are to deviate. So if you're a climate conscious investor, should you aspire to very closely track what is a misaligned market? We put out a paper slightly provocatively called the tracking error. And I think that's one issue to think about. And another way, perhaps, this is a bit of a critique on some of the existing passive solutions in the market, is this problem of averages. The fund is on average, its carbon footprint looks a certain way. But if you look, for example, at the forward-looking measures I've mentioned, are the actual holdings themselves considered aligned with Paris, for example? And you can see we've done this analysis that even more than half of the constituents of some claiming Paris-aligned indices are not themselves Paris-aligned. And that is a question that speaks to some of the audience questions around, what is classed as an Article 9 fund. Part of the reason why there was a downgrade, I think, was exactly this problem that on average, the fund looked all right. Then regulators tightened the rules. So people all of a sudden were exposed a bit, saying, and actually we didn't have a majority of holdings. And that's been a little bit some of the design principles we've tried to bake into our climate strategy. All the holdings should be considered aligned. And that, I think, is an interesting way, in our view, to think about how to start building a strategy, whichever vehicle it happens to be in.
Sorry, yeah. Thank you so much for that answer. I definitely think this is a great place to segue into our last question, considering that you're definitely right. What is within ESG funds is currently under scrutiny. Your research on sort of Paris-aligned funds and other pieces of research have sort of highlighted this issue. Given all this controversy and dilemma in the market, I wanted to start with you, Ronya, in terms of what advice do we have for investors who are looking to implement a sustainable investment strategy, in summary of this panel?
Yeah, broad question. So we've already talked about so many items, so maybe just very briefly to kind of recap. So I think first, stating the obvious, we're in the middle of an acute climate crisis. So no matter whether you're looking at this from a risk mitigation perspective or from an impact perspective, you might be asking different questions and hence needing different types of data, but there's no way around these considerations, no matter where you're coming from. So I think that's number one. Number two, we touched upon data availability being a challenge, and I'm not going to deny it is, but I think it's definitely not an insurmountable challenge, so don't let that deter you. We already mentioned a lot of the regulations that have come in over the last years and the last decade that have really accelerated reporting and also standardization of reporting, so we have a lot more data available. But of course, still, there is need to complement that reported data. So just to give you a sense, at ISS ESG, today, we cover over 30,000 issuers with our carbon data, and we see that Scope 1 and 2 reporting is really prevalent, but with Scope 3 reporting is often very patchy. So we have to add modeled data to that. And then lastly, you were already alluding to also the discussions related to greenwashing, potential greenwashing. And if we look at the latest report from ESMA on their progress report on greenwashing, they really emphasize that one of the main drivers for greenwashing is that there's only a limited pool of assets that can really be considered sustainable today. And hence, but there's a huge demand. So with that in mind, I think it's really important that we start looking at forward-looking metrics in particular, because we're not in a place today where everything is sustainable, but we need to get there. And for that, the EU Taxonomy is actually a really nice tool, because it also mandates capital expenditure reporting, so green capital expenditure. As of this year, non-financials that are subject to the reporting requirements actually have to report that, and this is a really exciting development in making that data available so that we can look at companies from that angle.
Amazing, and thank you so much for that answer. Data availability, looking at the assets in the market which are limited, and trying to use that data to mitigate greenwashing will definitely help. To touch upon briefly Mateo's question, I think our panelists sort of addressed that half of our, if half of Paris-aligned industries are not actually Paris-aligned, definitely within Article 9 funds, it appears there would be a similar challenge. And hope to wrap this panel up. If anyone has any closing thoughts to share on this topic, perhaps a moment.